Exercise 9-21, Notes Receivable and the adjusting entry for interest accrued at the end of the year. So Marathon Running Shoes reports the following. So we've got 3 transactions in 2016 and 1 transaction in 2017. We're going to journalize all entries required. Of course, debits are recorded first and credits, and then we'll have an explanation. So let's start with this one. February 4th. Recorded credit card sales of $96,000, net of processor fee of 1%. And then we're just going to ignore cost of goods sold just to keep everything simple. So what's going on here is we made some credit card sales, so we're going to get some cash. But notice it says net of processor fee. So we have to take out the processor fee of 1%. Processor fee means the company through which you accept credit cards, and then they process the credit card transactions for you. And their fee is 1% of the sale. So we're going to have to record some credit card expenses, and then we have to record our sales. So the sales are $96,000. The credit card expense, and remember expenses are debits, they increase on the debit side, is going to be 1% of that. So 1% of 96,000 is 960. And then so the cash is going to be 96,000 minus the 960. That gives us $95,040 of cash. So we're recording credit card sales net of the fee, similar to a problem we did earlier. Now we're going to get into the notes receivable stuff. September 1. Loaned $23,000 to Jess Pritchett, an executive with the company, on a 1-year 12% note. So because it says note and we're doing the lending, this is going to be a notes receivable for us. So we now have an asset called notes receivable, and we attach the name of the person who owes us the money, and the note, which is a loan, is $23,000. And we have to give Jess $23,000 of cash. Recorded loan to an employee. So notice this happened on September 1st. It is now December 31st, so it's the end of the year. At the end of the year, we have to update all of our accounts. In other words, we have to make sure our assets are correct, our liabilities are correct, our equity is correct, etc. Well, one asset what we have earned here is interest. From the time between September 1 to December 31st, we have been earning interest. And because it's the end of the year, by law, we have to record how much interest revenue we've earned, and then we have to show our assets correctly by showing interest receivable. So let's talk about the timeline. So in Excel, I just created this timeline to show you what's going on. So on September 1st, 2016, we signed the note. Actually, our Jess Pritchett, our employee, signed the note and gave it to us. And now it is December 31st. So we have to record the interest we have earned, but not yet received, from September 1 to December 31st. Now remember, the way that a note works is interest is not paid until the note is due 12 months later on September 1st, 2017. So we're not going to receive any cash until next year. So at the end of the year, we have to record our interest that we have earned. So how much interest have we earned? Well, I did this little thing to help you out. So how many months are from September 1st to the end of the year? Well, that's September, October, November, December. So that's 4 months. And then what is the formula for simple interest? The formula for simple interest is principal times rate times time. Principal is the amount of the loan, so that's $23,000. The rate is 12%. Well, where am I getting this information from? It's a 1-year note, and it's 12%. So anytime they have a percentage on a note, that means per year. So this is 12% per year. This does happen to be a 1-year note. So getting back to my timeline, we've got interest equals principal times rate times time. So principal is 23,000 times 12%, which is the same as 0.12, and then time. So how many months have gone by? 4 months out of 12. So remember, we're recording a partial year, so 4 divided by 12. And that gives us an interest of $920. Now, this is important for rounding. You need to do this formula from left to right. In other words, 23,000 times 0.12 times 4 divided by 12. And the reason why you need to do it from left to right is, let's say this was 7 divided by 12. If you did this first, 7 divided by 12, 7 divided by 12, well, let's do that on the calculator. Seven divided by 12. It does not give us an even number. It gives us lots of decimals. So people doing this calculation, some calculators will round it to just a few decimals. Some will round it to lots of decimals. So if you don't do it from left to right, in other words, if you started with it, now remember, we're pretending that this was 7 divided by 12. If we started here, 7 divided by 12, we get 0.58333333, unlimited threes. Well, not everyone's going to put in the same number of decimals. So when they then go and multiply it by the 0.12 and the 23,000, they will probably get a little bit different answer. However, if you just go from left to right, everyone always gets the same answer. So we're going to go 23,000 times 0.12 times 4 divided by 12. I'll show you on the calculator here. Clear this. So we've got $23,000 note times 0.12. Now I'm going to multiply by the 4 months and then divide by 12. And that gives us $920. Now, immediately, some of you are going to say, well, we're getting cash. No, that's not correct. Remember, with a note, the way a note works is the note, it does not get paid, and the interest does not get paid until the note is due. So it's not until next year, September 1, 2017, that we're going to get the note paid back to us plus interest. So on December 31st, which is what we're doing right now, the transaction, or the adjusting entry, I should say, for December 31st, is we're recording how much interest is owed to us. So that is interest receivable. And we also have to show how much interest revenue we've earned, $920. So Uncle Sam wants us to record this interest revenue so that they can charge us, or they can tax us on that revenue. And also our investors who read our balance sheet need to know that our assets have increased by $920 because Jess now owes us on December 31st, $920 of interest. So this is called accruing interest revenue. Accruing means something is accumulated, in this case interest, but has not yet been paid. Won't be paid until the note is due. All right. September 1st, collected the maturity value of the Pritchett note. So we're going to get some cash. Cha-ching! But how much cash are we going to get? Well, it's going to be the $23,000 of the note plus the interest. So let me bring my graphic up here. So we're now in purple, we're going to be calculating our interest. It's for the full 12 months. So again, principal times rate times time. So that's 23,000 times 0.12 times 12 divided by 12, which is just 1. So basically it's 23,000 times 0.12 gives us 2760. So that's how much interest Pritchett is going to pay us. But Pritchett also needs to pay back the principal. So the amount of cash we're going to get is the $23,000 plus the interest of $27.60. So that's what, $25,760. 25,760. All right. So let's go back up here. Notice at the end of the previous year, we recorded interest receivable. So once Jess Pritchett, the person who took this loan out from us, once they pay us off this interest, do they still owe us the $920? No. So we have to get rid of this receivable. So how do we get rid of a receivable, which is an asset? You have to credit it. So we're going to credit interest receivable by $920. Now let's go back to our timeline. So we have earned and we've earned and received this $27.60 of interest plus the original amount that we loaned them, the principal. And we've recorded that we've earned 4 months. So these 4 months were earned and recorded for last year. But have we recorded these remaining months that we have earned interest? No. So we need to do that on September 1st. When we receive that interest, we have to show how much we've earned that year. So here's my calculation in green. So how many months between January 1st to the beginning of September? That's 8 months. January through August. Don't count September because this is the 1st of September, not the end. And also we know that we have to record a total of 12 months. So this 4 months plus whatever this is going to be has to equal 12 months. So that's another way that you know that this must be 8 months. So let's calculate how much interest we've earned for 8 months. 23,000 times 0.12 multiplied by 8 divided by 12 should give us 1840. I'll show you on the calculator. Just remember to go from left to right. So we've got, let's clear it, 23,000 times 0.12 times 8 months divided by 12 equals 1840. So that's the interest we've earned from January 1st to September 1. So interest revenue. Okay, so now notice this still does not balance. So let's go back up to the very beginning. So when we issued this note, when we received this note from Jess, who signed it, we showed that Jess owed us $23,000. Now that he's paid us off, do we have this receivable, this note receivable anymore? No, we need to get rid of it. So how do we get rid of a receivable? We have to credit it. So we're going to credit the receivable by $23,000. Note receivable is going away. Now this is critical. Because of rounding errors, the debits and credits might not add up exactly. So what I want you to do is add 920 plus 1840 plus 23,000. Let's see if that equals 25,760. I believe in this problem it does, but when you do the random version of this problem, it might give you one where, because of rounding differences, it might not add up. And I will tell you what to do with that. So we got 920 plus 1840 plus 23,000. And hopefully it gives us 25,760. Yes, it does. Now, if that does not give you 25,760 exactly, and you still have recorded these correctly, that means you're probably going to be like $1 off due to rounding. So if that's the case, what you need to do is you need to adjust this interest revenue either up or down, probably by just $1, to make this journal entry balance. And so this is collected note receivable plus interest. And that's it.